All right, well, good morning, everybody. I think it's still morning. I apologize. I had some slides I was going to share with you, but haven't been able to figure out how to get them on the screen. So my name is Alan Lane, and I really appreciate the opportunity to be with you here today. As you can see from the screen behind me, I'm with Silvergate. Silvergate is the leading provider of innovative financial infrastructure solutions and services to the growing, fast-moving digital asset industry. I'd like to share a bit of our crypto journey with you. And in keeping with the theme of that last session on regulation, I thought I'd share the Silvergate story at the intersection of innovation and regulation. I'm going to start with an obvious statement. Regulators don't get paid to take risks. I've often reminded our team of this as we interact with our own regulators on potential new products and initiatives. Regulations exist to protect people, our fellow citizens, often referred to in the regulations as consumers, and to protect the integrity, the safety, and soundness of the financial system. Not only do regulators not get paid to take risks, but we also have to remember that they did not make the rules. Regulators are not villains. They're our neighbors, they're fellow citizens who have been charged with protecting the financial system that we all rely upon to form the capital, the equity, debt, derivative instruments, et cetera, that we need to grow our businesses and the economy. But regulators face a challenge many of us in our own businesses face. The speed of innovation is faster than regulatory change. Let's look at a current example, one that's been discussed quite a bit this morning already. Consider the speed at which DeFi, or decentralized finance, has grown. Data from the block indicates that revenue generated from DeFi grew from almost nothing in the middle of 2020 to over $1 billion in just 10 months. Uniswap is a decentralized exchange. You've heard about it a little bit this morning. And that means it is not owned or operated by a single entity. It uses smart contracts to facilitate a new type of trading model, an automated liquidity pool. This DeFi exchange includes a protocol native token, referred to as Uni, that has a market value of just under $15 billion when I checked yesterday. And it's less than a year old. Do you know how long it takes and how expensive it is to launch a regulated financial institution in the United States? Many of us in this session know this only too well. And what about the emergence of non-fungible tokens? You've heard a little bit this morning, I think, about NFTs. If you're a regulator, how do you keep up with this pace of innovation? It's quite literally impossible. Having said that, many regulators are not only receptive, but eager to embrace innovation. I believe that most regulators and lawmakers understand what's at stake: the prominence of the US dollar as the global reserve currency. The US dollar enjoys what could be the greatest network effect of all time. In one sense, regulators are charged with defending the network of the US dollar. I believe the best way to defend this network effect is to embrace innovation and create a regulatory environment where our greatest inventors and entrepreneurs can succeed right here in the United States. If we can't create this environment where businesses work together with regulators, then the innovation will go offshore, and the United States will, at best, miss out on this innovation, but at worst, create a significant vulnerability for our fellow citizens. I believe that regulators want to embrace innovation because it's in all of our collective best interest. But regulators need us in the private sector to do our part. What does that mean? Well, it means that you can't figure out regulation after product market fit. As the crypto bank, we've had thousands of potential clients approach us over the years. Unfortunately, many of these, perhaps also counted in the thousands, had products or business models that had not considered the regulatory framework in which they would operate. A lot of these new products and business models could end up being the platforms that drive better customer experiences, cheaper payments, and better access to the financial system, if not a complete revolution of money. What has been disappointing, however, is how many of these prospective clients have not done the research to figure out which laws may or may not apply to them, which licenses are required for them to launch their business, or which regulators may have jurisdiction over the products they are planning to launch. So many of these firms take the approach that they'll figure out compliance and regulation after they find product market fit. In many instances, we're not talking about spending hundreds of thousands of dollars in legal fees or millions of dollars to establish a compliance department. We're talking about relatively basic elements of regulation around know your customer, lending and securities laws, etc. Admittedly, in some instances, the laws and regulation aren't clear, and additional research is required. But in our experience, most regulatory agencies are willing to take your call and discuss a new innovative product or idea. So it's incumbent on founders and entrepreneurs to do the work. Remember, regulators don't get paid to take risks. And while they are eager to engage, they don't have excess funding to devote to every entrepreneur's bright idea. I would not suggest that you go into the regulatory agency asking them to help you figure it out. So if you want to speak with a regulator about a new product or a new model, our advice is do the work. Doing the work means researching the regulations themselves. The regulations are publicly available, and there are thousands of attorneys that will gladly help figure out how to interpret the law, for a fee, of course. Use this research to inform the regulator why you believe the proposed activity is permissible. Explain how you intend to comply with the law, the controls you are putting in place, and how you plan to protect the users, your fellow citizens, often referred to as consumers in the regulation, as I mentioned, how you intend to protect them on your platform. For those entrepreneurs out there that have never done this before, perhaps you understand tech or markets or infrastructure, but don't understand regulation. Our advice is find a co-founder who does understand. It's not enough to hire a head of compliance. You really do need someone that is both entrepreneurial and has an aptitude for working with regulators and attorneys on complex issues. We literally have hundreds of regulated clients at Silvergate. And those who have successfully figured this out, unfortunately, though, those who haven't figured it out are not successful, but those who are successful have figured it out. So now I want to transition a little bit and tell you about the Silvergate journey. We started our journey in crypto in 2014. Bitcoin companies like Coinbase, Paxos, which was known back then as itBit, and Zappo were getting kicked out of banks. And all they really needed at the time was a basic business banking account. So we educated ourselves on these businesses and their activities. While Bitcoin was certainly new and novel, as we researched existing banking regulations and how these new businesses were interacting with their customers, we determined that there was in fact an existing regulatory framework we could apply to this innovation. These were essentially money service businesses, and they were developing their own compliance programs and obtaining the licenses they needed to run their business in satisfaction of existing regulations. But we didn't stop there. We had conversations with our own regulators, both California state banking regulators and the Federal Reserve, way back in 2014. We educated them on Bitcoin, the risks involved, and how we planned to mitigate those risks. 7 years later, Silvergate has over 1,100 digital currency related customers, and we believe our customers trust us even more because we intentionally entered this space, proactively engaging with our regulators from the very beginning. And over the years, we have continued to add additional products and services to help our customers grow their business. Our flagship product is the Silvergate Exchange Network, or the SEN, which we launched in 2017. By 2017, we had successfully navigated several regulatory exams, and we were confident that our regulators understood this new line of business. We began talking with our clients about how we could do more to help them solve their problems, and out of these conversations, the SEN was born. The SEN, the Silvergate Exchange Network, is a real-time US dollar payment system that allows our clients to send US dollars to each other 24 hours a day, 7 days a week. To build this product in a way that would allow our customers to scale their businesses, our clients told us that the SEN would need to be API enabled so that our exchange customers could programmatically attribute deposits and make payments without staffing an operations team on nights and weekends. As you might imagine, being a bank that was building an API to allow bank customers to make faster payments back in 2017 was a bit daunting. Could we do this in a safe and sound manner? Would our regulators approve? And would our customers use it? I'm happy to say that the answer to each of these questions was a resounding yes. In the first quarter of this year, our clients used the SEN to make over $166 billion in payments. That's an annualized run rate of over $650 billion. By way of comparison, PayPal did $936 billion in volume in 2020. And while not a direct apples-to-apples comparison, our annualized run rate of $650 billion compares quite favorably to PayPal's 936 last year. When we launched this product, we used the process that I spoke about earlier, engaging with our regulators to explain how we intended to comply with regulation and implementing the controls necessary to protect the users of the platform. And it worked. We used the same process to launch SEN Leverage, a Bitcoin collateralized lending product, in 2019. We talked to our customers, and recognizing the traditional prime brokerage was non-existent, it didn't exist in crypto, we decided to launch a new product in which we would lend US dollars collateralized by Bitcoin. And if you think that offering deposit services to this space in 2014 was a challenge, think about lending against Bitcoin several years later. But in the summer of 2019, we again approached our regulators. We explained the opportunity as we saw it, the legal permissibility, the risks and the mitigants, and within a few months, we were launching our pilot. At Silvergate, we are blessed to have a team of people who are both entrepreneurial and have an aptitude for working with regulators and attorneys on complex issues. It's still early in this product's life cycle, but as of the end of the first quarter of 2021, we had 196 million in commitments. Our latest innovation is the issuance of a US dollar-backed stablecoin. You've heard a little bit about stablecoins also in presentations and discussions earlier this morning. While our product is not yet in the market, you may have seen our announcement a couple weeks ago in which Silvergate will be the exclusive issuer of DMUSD. We believe the use of this technology for payments will enable faster settlement, lower costs, and financial inclusion. Issuing a stablecoin is something we've been thinking about at Silvergate and discussing with our regulators for quite some time. But frankly, we had questions about our own ability to get the stablecoin into the hands of the end users, the consumers. After all, Silvergate serves institutions. We're primarily an institutionally focused company. And while we have over 1,100 digital currency related customers, we didn't feel like we had the distribution to be successfully launching our own Silvergate branded stablecoin. Over the past several months, we've been communicating regularly with our regulators, just as we've done with all of our new products, and we're really excited about the upcoming launch of DMUSD. We believe that regulated US dollar-backed stablecoins could be the catalyst for continued financial innovation, and that stablecoins will be at the intersection of regulated banks and DeFi. While it's still early, most people think that much like Bitcoin and other digital assets, DeFi is here to stay. The decentralized nature of the protocols makes it almost impossible to turn off the technology. While there could certainly be regulation that makes it more difficult or constrains specific use cases, the speed of innovation is faster than the speed of regulation. So if DeFi isn't going away, what are we really talking about in terms of the intersection of DeFi and financial institutions? Today, you can put US dollars in a smart contract using USDC or another stablecoin and earn up to 8%. As bankers and risk managers, we know that in order to earn 8% in a zero interest rate world, there must be risk taking somewhere. Risk that the smart contract could get hacked, risk that the protocol and its native token economics are not sound, risk that the counterparty can't pay you back. And we know that deposits of stablecoins into smart contracts are not insured by a governmental agency. With all that being said, it doesn't appear that Gen Z cares. The rebuttal might be that they don't care because they don't understand or because they haven't suffered a big loss yet, and maybe that's right. Or maybe they really don't care. After all, we're talking about a generation that doesn't understand why you and I use email. For some of us in this session, we thought email was the greatest invention we had ever seen until we started getting hundreds of emails a day. But I think there's something bigger going on here. I think people want more control over their money. And I believe the younger you are, the more risk you are willing to take to have that control. We've seen it on platforms like Robinhood and with the GameStop issue several weeks ago. People want to participate in the economy and they want the rewards that they believe come with that participation. And the idea that they might lose some of their principal in order to participate is probably okay with them. So could DeFi be the answer? In many instances, stablecoins are backed one-for-one with US dollars or US treasuries sitting in reserve. Imagine that these reserves are sitting in reserves and not being used by banks to make loans. Then think about this at scale. Imagine a future where the aggregate value of stablecoins is in the trillions of dollars across several assets, and banks are holding the reserves but are not using those reserves to make loans. How will entrepreneurs source the financing they've historically relied upon to start a new business? Could the answer be DeFi? So far, most of DeFi has been a trading use case or borrowing for purposes of trading, leveraging in crypto trading. But imagine if holders of stablecoins could deposit their US dollars into a smart contract, earn an attractive return, and on the other end of that transaction, the borrower could convert that token back into fiat if need be to purchase inventory or finance construction. Sounds like a tokenized form of peer-to-peer lending. At scale, perhaps the stablecoins don't even need to be converted back into fiat dollars, and the business could simply use the borrowed stablecoin to pay salaries, purchase inventory, etc. Banks can still participate. And to be clear, what I've just described is not what Silvergate is contemplating with DMUSD. But one can see how the proliferation of unregulated stablecoins could cause concern for regulators and policymakers. So it's important for entrepreneurs to engage with regulators on these topics. With stablecoins as the potential gateway to the new DeFi, and central banks around the globe contemplating issuing their own central bank digital currencies, it certainly seems that banking as we've known it could be changing forever. Silvergate started this journey to provide banking services to the new Bitcoin ecosystem. In many ways, Bitcoin was the original DeFi. With its distributed ledger and its permissionless peer-to-peer protocol, and Silvergate provided the first 24/7 regulated on and off ramp from the traditional financial system to this new 24/7, 365 decentralized financial system. In order to survive and thrive, banks need to become as innovative as the customers they serve. As I shared at the beginning, the speed of innovation is faster than the speed of regulatory change. And it's up to each of us as entrepreneurs to do our part, to do the work, as I've said, so that this technology can flourish both in the United States and abroad. We certainly don't have it all figured out, and I don't think anybody does. But that's what makes this space so exciting. And as I've often said, it's a great time to be a Bitcoin banker. I really appreciate your time today. Hope you enjoy the rest of the conference. And with that, I'm going to let you all have an early lunch. And I look forward to seeing you all soon. Thank you.